Hello and welcome to Insurance and Bonds as Risk Management Tools for Construction Project Owners, a webinar brought to you by AIA Contract Documents. We're going to go over a few administrative items before we introduce the presenters and get started. First off, this webinar is recorded and we will send you the recording after today's session by tomorrow close of business. This disclaimer is in all AIA contract documents, education. The program and accompanying materials is provided for general AIA contract documents informational purposes only, never intended as legal advice. We suggest that you confer with your legal counsel. This presentation is protected by US and international copyright laws. Reproduction, distribution, and display without written permission is prohibited. And again, I just want to remind you all that we will be recording today's session. We will send you the recording by COB tomorrow. And if you have any questions, please don't hesitate to put them in the chat. We have quite a number of registrants for today's webinar. We'll try to get to as many questions as possible, time permitting. And now I'm going to turn it over to one of our presenters, Ken Cobley, to introduce himself and get started. Ken?
Great, thank you, Hasti, and welcome everyone. There are going to be three presenters on our program today. I'll lead off with some discussion of insurance elements related to the owner and the contractor, and then Jimmy Germano is going to provide information relating to insurance issues for design professionals, and then Mike Bomba is going to bring us home with some information about surety bonds. Let me start by giving you a little bit of background about me, and then I'm going to ask Mike and Jimmy to also jump in here so that you have some sense of who the speakers are today. So I am Vice President and Counsel for the AIA Contract Documents program. I've been with the program a little over 16 years. Prior to that, I practiced construction litigation in a variety of firms, and I've represented owners, contractors, developers, subcontractors, suppliers, and design professionals in a number of venues and a number of dispute resolution modes, including litigation, arbitration, mediation. So that's my background. Mike, you want to jump in and provide a little bit of background on yourself?
Sure. My name's Michael Bomba, and I'm, like Ken, I've been with the Contract Documents program for a little over 16 years. Before I was with AIA Contract Documents, I practiced construction law in the DC area, primarily representing design professionals.
Jimmy?
Sure, thanks, Ken. So my name is Jimmy Germano. I am Senior Manager and Counsel with the AIA Contract Documents program. I've been with the program about 4 years now. And before then, I was a construction litigator for about 7 years in the DC area, mostly representing owners and general contractors on everything from contract negotiations to during sort of in-project claims and claim analysis, requests for equitable adjustment, things like that, to post-completion mechanics liens, litigation, arbitration, and then also some work on government contracts, both on the local, state, and federal level before the various administrative agencies that handle those types of claims. So that's a little bit about me. Thanks, Ken.
Great, thanks, Jimmy. Before we get started, we always like to provide a little bit of information and background about the AIA Contract Documents program. And while this webinar is going to focus primarily on issues associated with how insurance and bonds can help protect the interests of the parties on a project, and particularly the owner and some contractor and design professional. We will use some elements of the AIA's contract documents as references or examples. So let me give you a little bit of the background. So first of all, the AIA Contract Documents program has been in existence since 1888. That is not a typo. So we've been at this for 130 years plus or minus. Over that time, the program has evolved to reflect practices in the construction industry. That is to say that one of the guiding principles for development of these documents is that we want the documents to be updated, refreshed, and constantly to reflect what we understand to be the most common or best practices in the industry around each of the various issues that the documents address. And one of the main principles that has guided the development of these documents over the years is where to place risk. We try to pride ourselves on being fair and balanced and equitably apportioning risk, and part of that is a decision about where to place risk in the terms of the agreements. And we try to put it where it's best managed, and by that we mean either on the party in the best position to control the risk, or on the party in the best position to insure against the risk. And from the outset, the AIA documents have always included insurance provisions to help manage project risk. So before we get into the owner's insurance, I did want to just mention that in 2017, we did a major revision of the clauses in the owner contractor agreements and in the A201 around insurance. Up until that point, all of the insurance requirements and terms were found in Article 11 of the A201, and in 2017, we broke that apart. We carried some of the main clauses are still in Article 11 of the A201, but a lot of the details surrounding owners insurance and contractors insurance are now found in an insurance exhibit that accompanies each of the major owner contractor agreements. And we did that for several reasons, and we'll talk more about that later. But I do want to mention that because one of the key reasons we did it was to allow the parties to discuss on a project by project basis what the insurance needs might be, and to, in essence, create project-specific insurance requirements that would best address all of the needs of the project. And we'll go into that in a little more detail later on in the presentation. So what can go wrong on a construction project? And this slide just shows any of a number of, and this is by no means all inclusive, but this is any of a number of things that might go wrong and negatively, adversely impact the project or one of the parties to the project. There might be a fire. It might be a limited fire, or it might be a catastrophic fire. You might have a flood. Some of these things might result in business interruption. If you have an event, a negative event, it could adversely affect the owner's ability to continue to conduct business until things are straightened out. There could be personal injury on the project site or resulting from something that is connected to the project site. You could have professional negligence. Something went wrong in a design element. And you could have contractor performance issues, either poor workmanship or some other failure to follow the contract documents, or there may be business issues, failures in payments to subcontractors or suppliers. Now, how do you manage against those risks? Well, many of those risks can be managed through different insurance policies and types of insurance protection that either the owner can carry or the contractor can be required to carry to address those risks. With respect to contractor performance issues, then you would look to surety bonds. And so we're going to touch on several of the different types of insurance that are available, some which almost, not almost, all projects should have, and there should be this type of coverage in place. Some of them will depend on the nature of the project, and some of them are purely optional considerations for the owner's business. And then we'll also talk about the main types of surety bonds and what they can protect against. Takeaway number one, owner's insurance. If nothing else, owners should have a general liability insurance policy in place, and they should obtain or make sure that the contractor is going to obtain a builder's risk, all risk policy to protect against catastrophic loss on the project. This would be the scenario where the project is almost complete and there is an electrical fire or some other source of ignition and the majority of the project burns to the ground. Builder's risk is going to be what's going to respond to that type of catastrophic loss, and so it should be in place. And we'll talk a little bit more about that later on in the presentation. What are some of the builder's risk considerations? Well, the first thing that you want to address is what is the total coverage, and you want to make sure that the builder's risk policy that's in place is going to cover the value of the entire project on a replacement cost basis. In other words, if the catastrophic event happens at the very end, right before substantial completion or at substantial completion, you want to make sure that there's going to be enough policy limits to rebuild what's been lost. And that should at least be at the contract sum plus any modifications as they go along that might increase the total value of the cost of the work. It should be maintained to at least substantial completion. And then after substantial completion, you'll need to make sure that there is continuing coverage, either through the builder's risk or some other replacement policy, at least until the expiration of the period for correction of the work, right? So you have substantial completion, and then there's a correction period after that where the contractor or its subs may still be on the project. And so you want to make sure you have ongoing coverage even after substantial completion until the end of that warranty or correction of the work period, so that you have this kind of coverage in place, because catastrophic events can happen at any time. You also want to make sure that the owner, contractor, subs, etc., are considered as additional insureds, and also that the policy protects the interests of mortgagees as loss payees on the project. So I think that these are important coverage issues. If an owner is not constructing a new or standalone facility, but is remodeling or adding on to an existing structure, you want to make sure that the builder's risk will cover all of the existing structures as well. And it should be on a replacement cost basis, and protect all of the existing structures against direct physical loss or damage. And that's an important consideration, right? Oftentimes, projects are coming out of the hole and are not at all connected to adjacent buildings. But on occasion, projects actually are additions to existing structures. And so, you know, you want to make sure that the builder's risk policy will respond if the catastrophic event not only consumes the new construction, but also damages the existing or building that is being added to. And so what are the kinds of losses that builder's risk insurance should cover? This is a listing. I'm not going to go through each one of them. But if you look at the AIA's documents, we have specific terms that will make sure that the builder's risk coverage is crafted to include all of these various types of losses or damages, or at least when sent to an insurance advisor, you'll be able to determine if there's going to be a gap, something that isn't going to be covered by the builder's risk that you're purchasing, and to discuss with them, well, can we get that coverage? What would it take to get that coverage? Or at least know, you know, in this particular instance, we don't have quite the coverage described in the document, but we know what we have. The worst time to find out about builder's risk, whether or not there's an exclusion or something not covered, is after the catastrophic event happens. You want to know what your risk is up front and what protections you otherwise have in place. Now, part of what we want to talk about is not only the standard property insurance and commercial general liability coverage that the owner is going to carry, but also what other types of insurance might an owner want in order to protect its business interests. And so we've listed here some other types of insurance that an owner might want to carry, depending on the nature of the project and what it perceives its risks might be if there was an adverse event that impacted its business or other interests. So, for example, does the owner feel that it might want to carry loss of use, business interruption, or delay in completion insurance? An assessment by the owner. Okay, what could my potential loss be if if I'm unable to conduct my normal business operations because the project goes on too long, or there's some other issue associated with the project? Do I need coverage for expediting cost issues, to get repairs done so that I can continue my business? I'm not going to go through each one, but I think you can tell by the title of the insurance and the description what kind of losses might be covered here. Again, more of the various types of coverages. Ingress and egress insurance. If for some reason something on the project prevents the owner or businesses from being able to actually gain access to their business, to the building, or for customers, do I need insurance to protect against that? How catastrophic would that be for me as an owner if something happened? And might it be worth my while as an owner to pay the premium and get insurance against these types of issues? And so each of these coverages is set out in the AIA's insurance exhibit as optional owner coverages that the owner should consider and perhaps get, depending on the nature of the construction project and the nature of the owner's business. In addition, there might be still other types of insurance, like cyber security insurance, that the owner might want to get. I think you're probably all familiar with one or more instances where nefarious parties have gotten into the owner's record systems and data systems through some player on a construction project. There's I won't mention names, but there's a fairly famous case where a subcontractor was accessing a very large international corporation's systems, and hackers got in and got customer data from that very large business concern. And so the question would become, how much is the coverage, and is, in my particular situation, is that coverage worth the price of the premium to give me some peace of mind? So we've talked a little bit about the owner's concerns and what the owner wants to take into consideration with respect to potential insurance coverages. Let's talk a little bit about what the contractor's insurance might look like, and why having adequate insurance by the contractor is important, not only for the contractor and subcontractors, but also for the owner's interests as well. So first of all, what should an owner know about a contractor's insurance? We think that it's good business practice and a smart step by the owner first to require that the contractor provide certificates of insurance to the owner, just to evidence that the required coverages are in fact in place, and to present those periodically to make sure that the appropriate coverages are being renewed. In addition, the terms in the AIA contract documents require that the owner be named as an additional insured on certain policies, including the contractor's commercial general liability policy, and any umbrella policies that might be added on for additional coverage to meet policy limits as required under the contract. And the owner should be an additional insured for claims caused in whole or in part by the contractor's negligent acts or omissions during the contractor's operations, and for losses occurred during completed operations. Also, the additional insured coverage should be primary and non-contributory. That is, it should be the owner as an additional insured should be the first thing out of the box, and not necessarily look to other insurance to step up and cover it first. And we also prompt the owner to ask the contractor to disclose any deductibles or self-insured retentions applicable to the required insurance. That is to say, if the owner needs to make a claim as an additional insured, what would the out-of-pocket expense to the owner be if they have to incur a deductible, or if there's some self-insured retention that would be applicable that the owner would first have to come out of pocket. What types of general insurance coverages do we suggest that the owner require the contractor to carry? Well, commercial general liability, obviously. Also, auto liability coverage for owned or used vehicles that might be coming onto the project site. Now, in the AIA's documents, we say that the required limits, which the parties set themselves as part of the contract negotiation. But we establish, and certainly the parties are free to negotiate this, that the coverage, the required coverage limits for CGL and auto can be a combination of the primary policy plus an umbrella policy for this project, or in effect to cover the additional limits as required under this contract. We also have a clause in here, and this is very interesting, and that is that the excess policy should not require actual exhaustion of the underlying limits. And what does that mean? Some excess policies say that before they will kick in, the insurer on the primary policy or underlying policy has to have paid 100% of its obligation under the underlying policy. And sometimes that can be a problem. You may have an excess policy that is significantly higher than the underlying policy. For whatever reason, the insurer on the underlying policy may not be willing to pay the full extent of the policy, but you need to get to the excess policy in order for people to be made whole or to settle a claim or whatever. And so this requirement that the excess policy not require actual exhaustion just means that somebody else can step up to the plate and pay the difference between what the underlying insurer is willing to pay and the total policy in order to get to the excess policy. And that facilitates access to the excess policy, and also facilitates hopefully the eventual conclusion, resolution, and settlement of claims. In addition, obviously workers' compensation and employers' liability coverages would be very important, and a lot of that is covered by statute. But you want to make sure that those are also in effect for the contractors. In our documents, we also indicate that insurers should be licensed in the jurisdiction where the project is located, and that the contractor maintain the coverages until the period for the correction of the work expires. And we think these are all key terms and elements that the parties should be thinking about, and in particular that owners would want to have in place to protect their interests when it comes to contractors' insurance. Some CGL policies contain exclusions or restrictions, and it will depend on the insurance company and some other aspects as to whether the policy that the contractor is able to get has the exclusions or not. We started out in our document with a list of the things that should not be restricted or excluded. And again, if you think back to the purpose, this is to allow the owner and contractor to talk about the details of the nature of insurance that's in place for a particular project, and to make sure that the coverages are right. Sometimes a particular contractor with a particular insurance company cannot get an exclusion waived. Well, at least at that point, they would have to notify the owner that they can't get the exclusion lifted, or the policy has to have this exclusion, at which point the owner can tell whether or not they're willing to accept that risk, can look into alternate types of coverages or alternate policies that might provide the protection. And I'm not going to go line by line through each one of these, but I think you can see the types of exclusions or restrictions that an owner would not want, because you want, as the owner and usually as the contractor, you want the broadest coverage possible so that the insurance is going to respond to as many claims and as many causes of damage as possible. This is just more of the list. I'll just give you an example. Some CGL policies have an exclusion for exterior insulation finish systems. Some people call it EIFS, or synthetic stucco, or other things. If the project has none of that, then the parties may not care. But if there's some element of this stucco or EIFS systems at play in the project, then you may want coverage for issues that might arise with those systems. You may care whether or not there's an exclusion for claims related to earth subsidence or movement. If this is a condo project, you need to know whether there's an exclusion related to residential, multifamily, or habitational projects. Again, just some examples of what we have already listed in the AIA's insurance exhibit as not allowable as exceptions or restrictions, and prompting the parties to discuss those issues if in fact they have to be, or the insurer tells the contractor that those exclusions or restrictions have to stay in the policy. Auto liability, again, the contractor and others are going to be bringing vehicles onto the project site, all types of vehicles. And so you want to know that the liability coverage extends to vehicles owned or non-owned vehicles that the contractor uses. You also want to make sure, and you're prompted to do this with the AIA documents, you want to make sure that you indicate policy limits per accident within the required coverages. And you also need to be aware that certain statutes may require additional auto coverage. And so you need to take that into account when structuring the types and limits for auto policies. So we've talked about the things that the contractor should, we believe the contractor should always cover on a project, the types of policies. There may be some projects that will require additional types of coverage depending on the nature of the project. And we've listed those here. So for example, if the work involves any hazards that arise from work on or near navigable waterways, including work that might involve vessels or docks and piers, then the contractor might need to carry Jones Act and longshore and harbor workers compensation insurance. If you're in the middle of a cornfield, it doesn't apply. But again, if it's near navigable waterways, then you need some additional coverage, or you at least want to consider that. Professional liability. If the project involves delegated design, and almost every project does, then you probably want the contractor carrying professional liability coverage for those elements of the project that they're actually designing. Pollution liability coverage, if the contractor is going to be bringing pollutants onto the project, either transporting them in on one of their trucks and using them for the construction, or some site of pollutant might inadvertently be released into the air, you may want pollution coverage in existence. If they're going to be using manned or or unmanned aircraft. You may want some additional coverage for that, depending on where the project is and what the potential risks are. Maritime coverage, of course, for anything around waterways, so on and so forth. So again, these are not necessarily applicable to all projects, but may be applicable depending on where your project is located or what the nature of the contractor's work is going to be. And so under the AIA contracts, we say if the work includes, for example, if the work involves hazards arising from work on or near navigable waterways, then the contractor will carry Jones Act and longshore and harbor workers compensation. And we have a similar statement for each of the coverages that you see here. And so it's not really an optional coverage as written into the AIA documents. It is a required coverage if the work of the contractor is going to involve certain elements or be associated with certain conditions. What are some of the optional coverages that a contractor might have? Well, we talked early on about builder's risk, and we put that in the owner's coverages because it's an important coverage for the owner, right? The owner wants to have the project replaced and any surrounding buildings replaced if there's a catastrophic event. And historically, the owner got the builder's risk coverage as part of the property insurance on the project. However, we've learned more recently that contractors can often get that coverage, and in fact can get it cheaper. Why that is, I don't know, but that's just where the industry has gone over the last several years. And so the AIA documents start from the premise that the owner will get the builder's risk policy, but allow the parties to shift that burden to the contractor if the parties so agree. Other optional coverages might include railroad protective. So if you have a project close to existing rail lines, you may need or want to get railroad protective. It is an option depending on what the specific nature of the project is and where it's located. Asbestos abatement, coverages for property in transit or stored, or additional insurance for contractor-owned property. Again, these are optional coverages, and in the AIA documents, they're not required, but there's something for the owner and contractor to consider and talk about, given the nature of the project, where it's located, and so on and so forth. So, as I mentioned earlier and throughout, the AIA uses an insurance exhibit now for most of its major owner-constructor agreements, whether that's in design, bid, build, or the CM families, CM as constructor, or CM as advisor, or in design build. It is an exhibit that prompts the parties to lay out the various coverages that the parties feel they need and that the owner in particular wants to have in place to help protect their interests. As I mentioned before, there are certain key requirements and terms that are still covered in the general conditions documents. The general obligation to purchase the insurance required by the contract documents. Obligations associated with giving notice when there's been a cancellation or failure to obtain a required type of coverage, either by the owner or by the contractor. There are terms related to the waiver of subrogation, which has been a key element of the AIA's documents and is often found across the industry when it comes to insurance coverage. And then there are terms related to the settlement of losses. Somebody has to take the lead on settling claims when there's been a catastrophic event. And so the AIA documents lay out, give the owner the right to take the lead in settlement, but gives the contractor also rights when it comes to agreement to the settlement or how to make claims if they don't agree to the apportionment of settlement proceeds. And why an exhibit? Because as I mentioned earlier, the exhibit allows the parties to develop project-specific owner and contractor insurance requirements. And I think I've given you many, many examples of that so far. Again, in some circumstances, specific coverages or exclusions or the deletion of exclusions might be difficult to obtain. But the exhibit at least allows for the issues to be raised for a discussion so that the parties can assess the risk and make alternative plans. And in particular, the owner should know up front if certain risks may not be insurable and what its options are, including accept the uninsured risk, pay a premium for coverage, or make changes that are needed to obtain coverage. And so that sort of is the philosophy behind why we have gone to an exhibit. The exhibit forces the parties who are negotiating a contract to look at the detailed requirements. Also, as an exhibit, the exhibit can be sent to insurance advisors for a comment. The contractor may send the exhibit to its broker and say, am I good on the CGL coverage? And do we have any of these exclusions that I need to raise with the owner? And so on and so forth. So that covers the background and elements, very top line elements related to issues for the owner's insurance considerations and the contractor's insurance considerations. I'm going to turn it over now to Jimmy, who's going to talk a little bit about design professional insurance requirements.
Sure. Thanks, Ken. And we're just going to cover just a couple of slides here on design professional insurance requirements. But before we do that, let's sort of pause here on this first slide where you're seeing just a couple high-level points about design professional insurance, and take a step back and just consider from whose perspective are we talking about design professional insurance. This is a presentation talking about construction project owners. So the information here in these next couple of slides is targeted toward basically saying, from an owner's perspective, what do you need to know about the insurance that your design professional or design professionals have on the project and what's important? There's separate presentations that we give that are targeted toward the design professional and saying, here are the things that you should consider. This isn't going to go into that kind of detail. Excuse me. So a couple of things to understand about professional liability insurance, basically, is what we're talking about with design professional insurance for the most part. Most of the time, professional liability policies are made on what are known as claims made bases, which means that you have to, both the event leading to the claim and the claim itself have to be made during the policy period. And that's different than an occurrence-based policy, which just means that the occurrence has to take place during the coverage period, but the claim can come in later. It's important for owners to understand that because of the nature of a third-party policy such as professional liability, to know what's covered and what's not covered with respect to those timelines. Sometimes a policy will be written on what's called claims made and reported, which even heightens the standard by saying that not only does the claim or the occurrence and the claim to the design professional have to occur within the policy period, but the design professional has to report the claim to their carrier within the policy period. So it's important to read the policies and understand exactly the time limits of coverage and what you're dealing with. A second nuance that you're going to see for professional liability policies relate to something that's known as eroding limits, or sometimes it can be called first dollar defense. And what that basically means is that whatever the limit is of that policy, the costs incurred in defending a claim are within that limit. Meaning, if you have $1 million policy and you pay $100,000 to your outside counsel, you only have $900,000 left to pay a claim or to settle the case. That's different than other policies. Other policies stack the defense costs and the actual coverage, so your coverage doesn't change. It's important to understand that because as time goes on with respect to a professional liability policy claim, the amount left over to cover a claim is going to erode the longer that claim takes. So it may be prudent to consider an earlier resolution when you have more of that, more of the pie to go around, so to speak. On the slide here, you're seeing 3 bullet points. These are just important to remember about design professional insurance. The first is that it's important to maintain insurance until termination of the agreement. And that's because a little bit about the claims made and reported issue that I talked about a second ago. And to understand that termination can be the end of the project when the contract or the agreement is going to sort of naturally terminate. It could also be termination by one of the parties. The owner can terminate, the architect can terminate, et cetera. Any of the requirements that are in addition to the types and limits that the architect normally maintains, the owner is going to pay the difference, usually for those premiums. And lastly, at least for the AIA contracts, for example, they require that the architect provide certificates of insurance to the owner, wherein they're going to evidence compliance with those insurance requirements. And that's just sort of a best practice generally. If you're an owner, you can request certificates of insurance from all of the parties that you've contracted with, and vice versa. If you're a contractor, if you're an architect, et cetera, you want to make sure that you, as a best practice, you can obtain those certificates of insurance to make sure that everyone has complied with their insurance requirements. Like Ken said, you don't want to find out that the builder's risk policy doesn't cover a certain thing after a claim has been incurred. And then next, we're going to talk about some of the specific coverages that design professional insurance covers. Design professionals can obtain anything that you see here on the list, something like CGL, which can cover it in detail, auto, workers' comp, employer's liability, and then, like I talked about a second ago, professional liability. That third bullet point, primary and excess or umbrella liability, that's not a specific coverage per se. It's more so in there to understand that those first 2 bullet points, your CGL and your auto, you can get to those required limits using either standalone CGL and auto policies, or you can have lower limits on your CGL and your auto, and then an umbrella that gets you up to the limits. The only sort of caveat to that is, as you have to be in a situation where the insurance policies, when they're combined, they result in the same or greater coverage as the coverage that's required for the individual CGL and auto. So as long as you are getting to the same place, you can do it through standalone or by combining your primary with your excess, or sometimes it's referred to as an umbrella policy. And then workers' comp, it's important to understand what your statutory limits are. So again, you want to talk to an insurance professional or outside legal counsel to understand where your workers' comp limits are and what you need to have. Employer's liability, and then again, PL, professional liability. With respect to additional insured obligations, I'm not going to go into too much detail because Kent covered this really nicely during the owners and the contractors insurance requirements discussion. But the same requirements are going to apply whether or not you're talking about a contractor and the additional insured obligations toward the owner, or a design professional and their additional insured obligations toward an owner. It needs to be added on the various policies. It needs to be primary and non-contributory, and it has to apply to both ongoing and completed operations. So those sort of standard requirements for additional insureds, they're going to apply whether or not you're talking about design professionals or contractors. And that additional insured obligation and that framework is set up that way to work in tandem to some of the contractual insurance elements that Ken talked about, such as waivers of subrogation, for example. It sort of works hand in hand with contractual requirements and aspects like that. That's sort of a brief overview of design professional insurance, and then we're going to turn it over to Mike to handle the fascinating world of surety bonds. Mike?
Thank you, Jimmy. I hope I can live up to the lead-in, but we are on to surety bonds, and we are out of the insurance product portion of this presentation. I make that point to help frame the discussion about what is a surety bond. While almost all bonds are probably written by insurance companies that are licensed by the various states, departments that regulate insurance providers in that jurisdiction, surety bonds themselves are not insurance products. Insurance products are really a two-party agreement between the insurance company and the insured. They may ultimately benefit someone else, but they're really an agreement between the insurance company and the insured that if a particular identified loss occurs and certain conditions are met that are outlined in the insurance policy, the insurance company will protect and make that party whole, subject to the terms of the policy. A surety bond is different. So it is a three-party agreement where the surety is not going to necessarily make the what would be the equivalent of the insured hold. They're really guaranteeing the performance, typically of the contractor or subcontractor, which is usually called the principal in a surety bond, that it will perform in accordance with its underlying obligations. And it's making that a promise effectively to the owner. In a subcontractor arrangement, the principal would be the sub and the contractor would become the obligee. But it's a three-party arrangement. And I guess another major difference between surety bonds and insurance policies is that when a surety company writes a bond, it doesn't actually expect to take any kind of a loss on that bond. Insurance works a little bit differently. Insurance companies have a complex system and process. It's possibly mystical, but definitely based in mathematical probabilities to calculate a premium that each of its insureds will pay. And the expectation is that across its entire portfolio, it will make enough money through premiums to cover any potential losses that may occur under any of its insurance policies. Sureties are different. The bond, they don't actually expect to incur a loss. So the first reason that is the case is because they expect the contractor that they are guaranteeing, whose performance they're guaranteeing, they expect that contractor to perform its obligations. And if that's the case, then the surety never comes into play and there's no real loss to the surety. The other aspect is that if the surety does have to step in and back up the performance of the principal, the surety has required the principal to sign an indemnity agreement, essentially saying that they, to the extent the surety has to step in, they will indemnify the surety for whatever it had to do in terms of satisfying the bond. So they're very different. They're structured very differently than insurance, even though they are often written by insurance companies. And even in presentations like this, they're paired with insurance products. So what's the real value of a bond? I think that obviously there is the, specifically to an owner, obviously there is the value of what the bond itself protects. And we'll get into a little bit more about that in the next slide. They can protect performance. They can make sure payments are made to subs and sub-subs and material suppliers, et cetera. So those are examples of the direct benefits of the bond. But behind that, there's an additional value of the bond, and that really derives from the fact that the surety doesn't want to have any loss on this project, on the bond. So before they will even issue a surety bond on behalf of a contractor to get bonding capacity. In other words, a certain amount of bonds that the surety company agrees to provide on behalf of that contractor in a given period of time. To get bonding capacity, the contractor has to go through a extensive pre-qualification process. And this is a heavy investigation into their background, their capabilities, and their performance on past projects. It includes typically the review of the past 3 fiscal years' financial statements, copies of all their bank loan agreements, personal financial statements, summaries of their current work in progress, resumes of the owners and key personnel. So, and the list kind of goes on and on. But it is an exhaustive background search and vetting of a contractor before a surety company will give it bonding capacity. So why do I go over this? That is an added benefit to an owner. I mean, when an owner is out bidding a project, it's probably rare that they can get that kind of detail on the background of a contractor. So if a contractor has bonding capacity, an owner knows that a surety company has gone through the process of this detailed vetting of their background and is willing to stand behind them up to their bonding capacity. I think the other side to be aware of, again, is that because the bond requires the contractor or subcontractor to indemnify the surety for any losses, contractors are going to be inspired to make sure our project is completed, that their performance and their payment obligations are met, because they don't want to have the surety coming back at them to enforce that indemnity. And I think another value for bonds, it's not necessarily on its surface, are a lot of the silent services that come along with the bond. Again, sureties do not want to have to pay out on a bond, and so they will frequently intervene in ways that perhaps the obligee, the owner, isn't even aware of, to help the contractor avoid a default. Contractor default is almost always the trigger for the surety's obligations. So they'll work with the contractor to try and help them avoid a default. They'll provide assistance and additional benefits. They may, if it is a matter of the contractor needing a temporary influx of funds, they might even provide additional capital to a struggling contractor. We've heard of instances of them providing accounting and technical assistance as well. So, and as I said, oftentimes the obligee is not even aware that these services are provided. So it is another, so we call them silent services, another value of a bond above and beyond its face value of what it protects. And then, as we'll touch on in a little bit later, the costs of bonds are pretty low. But we'll touch on that in a second. There's really, in the AIA program, we have 4 types of bonds, and I'm just going to touch on this at a high level, just to give you an idea of what types of protection these bonds provide. Bid bonds, if you award a contract to a contractor through the procurement process, a bid bond essentially is going to cover the costs an owner may incur after awarding the job. But if for some reason you fail to enter into a final contract with that contractor, because you have to go through the negotiation process of finalizing the contract after the job is awarded. If for some reason you're not able to finalize the contract and you have to rebid it, those costs are covered by some of those costs can be covered by a bid bond. The main 2 bonds are really performance and payment bonds. Performance bonds say that the surety will essentially stand behind and guarantee that the contractor will perform its obligations under the contract. And if it doesn't, the surety will step in and either get that contractor to perform, find another contractor to perform, or pay the amount of the bond so that the owner can go out and and get the job completed. Payment bonds are a protection that the contractor will pay all of its obligations to subs and materials suppliers, so that the owner can feel comfortable that there will not be liens placed on its projects. And warranty bonds are similar to performance bonds in that they protect the performance of the work, but they're focused mostly on the warranty period after the project is over. So they are a smaller amount and more focused just on the warranty to make sure that a contractor would perform its warranty obligations on a project. In terms of cost, I know we're short on time, so I'll just go over this quickly. Costs are relatively low in the grand scheme of things. Generally, the costs of a bond are about 1%. Usually that's of the contract amount. Usually that's the pricing for the performance bond. Bid bonds are typically issued at no fee for a contractor that has bonding capacity, and payment bonds are usually issued in conjunction with the performance bond. So you're really looking at a relatively low cost for the type of protection that you get. I'll just pop up here some of the bonds that we have in our program and the numbers, and I'll point out that all of our bonds were developed with significant involvement from relevant surety associations, National Association of Surety Bond Producers, and the Surety and Fidelity Association of America. So we were drafted in conjunction with their input. So I just wanted to share that information. In our last slide, we just have some help information if you want to get anything else, any other info about our surety bonds, our insurance product, our insurance exhibit, or any of our other agreements. I'll just leave that up there. And then I'll pass it back to Hasti to take us to the end.
Thank you very much, Mike, Ken, and Jimmy, for this comprehensive presentation. We hope you enjoyed it. As I mentioned, you will receive the PowerPoint along with the recording of today's session by close of business tomorrow. If you have any questions that we couldn't get to today, please contact docinfo@aiacontracts.com. Thank you, everyone, and have a great afternoon.